Cybersecurity is one of the industries to invest in over the next decade. From smart homes to global enterprises, everything is online, generating terabytes of valuable data. And where there's value, there's a need for protection. And a leader in the cybersecurity world released their earnings report last week, yet took a punch to the mouth in the market. Fortinet has been a growth machine over the last decade in both cash flow and share price. So, with this pullback, is Fortinet a buy yet again? Welcome to the Quality Investor. If there's one thing defining our world in 2025, it's the digital revolution. This makes cybersecurity vital in today's world. The industry market size was reportedly $245.6 billion in 2024 and is expected to grow significantly in the coming years at about a 12.9% annual rate through 2030. So we're diving in to the leader in this space, Fortinet, ticker FTNT. Their Q1 2025 earnings was impressive yet again. But despite their stellar earnings, the stock dropped 8.6% the next day. Why? The market wasn't thrilled with the full year guidance, which was a hair below expectations, and some investors worry about growth slowing in this competitive space. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So today, we're going to unpack these earnings, the outlook, and the market's reaction. Cyber threats are evolving faster than ever. In 2024, we saw breaches like snowflakes exposing sensitive data for over hundreds of clients, and ransomware attacks costing businesses billions. And as AI powers more sophisticated attacks, and the Internet of Things connects everything from your fridge to your car, securing data is not optional, it's critical. Fortinet thrives in this environment, offering a holistic cybersecurity ecosystem. Think firewalls to guard network perimeters, AI-driven threat detection, and cloud-based solutions for remote workforces and smart devices. This is a cybersecurity fortress, integrating hardware and software to protect enterprises, governments, and even your home Wi-Fi. So what actually makes Fortinet special? In short, it's the economic moat. Fortinet's FortiOS platform seamlessly ties together firewalls, SD-WAN, unified SASE, and security operations. This integration creates high barriers to entry. Competitors need massive capital to match Fortinet's expertise and research and development. Once a business adopts Fortinet, they're locked in. This drives high switching costs. Moving to a competitor means ripping out and rebuilding entire security systems. That's expensive and risky. Then there's subscription revenue. Fortinet's services like maintenance, training, and security consulting generate predictable, high-margin cash flow. Their unified SASE and AI-driven security operations are growing like wildfire, up 26% and 30% respectively, with combined annual recurring revenue hitting $1.6 billion. Add in nearly a decade of AI investment for real-time threat detection, and Fortinet isn't just keeping up, it is setting the pace. Here is the high-level snapshot. Revenue was $1.54 billion, up 13.8% from last year, and in line with Wall Street's expectations. The product segment had $459.1 million, up 12.3%. This is showing strong demand for firewalls and hardware, something that wasn't there in 2024. Service revenue was $1.08 billion, up 14.4%, and fueled by subscription growth of 16%. And those aforementioned billings, the ARR, $1.6 billion, a 13.5% jump, with unified SAAC billings growing 18%. The gross margin hit 81.9%, up 380 basis points, which exceeded their guidance. And operating margin hit 29.5%, up from 23.7%. The takeaway from all of this? Fortinet is firing on all cylinders, balancing both growth and jaw-dropping profitability. And the $6.49 billion backlog signals strong future revenue. They expect $3.38 billion of that to be recognized in the next 12 months. Some interesting themes emerged on the earnings call. The company sees momentum building in the second half of 2025, driven by firewall upgrade cycles starting in 2026 and growing demand for SASE and security operations. Fortinet is also betting big on its integrated platform and AI to capture more market share. They also said there was no demand pull forward due to tariffs, echoing what Tim Cook has said about iPhones. They also mentioned key deals have not been delayed, despite some customers expressing hesitancy due to the macro news. And some 8-figure deals that were closed were already in the pipeline and not due to the pull forward of demand. Overall, Fortinet indicated minimal tariff impact. This flies in the face of the mainstream media narrative around tariffs and fear-mongering about looming recessions, which does remain a technical possibility. This makes the fall in the market even more frustrating. I mentioned that it was due to lower than expected guidance on revenue. The guidance midpoint is at $1.62 billion, and Wall Street's expectation was at $1.628 billion. I mean, you have to be kidding me. And on that point, Fortinet said the guidance reflected caution due to macro uncertainty despite strong Q2 close rates thus far. Such short-sightedness from Wall Street. Additionally, they're navigating a CFO transition. Keith Jensen announced his retirement. However, with Christiane Ohlgart taking over as CFO, it does ensure continuity. This market pullback is a complete overreaction. Fortinet's margins are industry leading. Their backlog is growing, and they're gaining share in high growth areas like SASE. Given all of that, does this dip, however, provide long-term minded investors with an opportunity to buy more? Let's assess the valuation and find out. Fortinet went into the weekend at $97.42, and you can see that big drop here on Wednesday post-market. Throughout Thursday, it did recover a little bit. The drop after market on Wednesday was as much as 12%, and then was pretty much flat going into the weekend. However, with an announcement over the weekend regarding a trade deal with China, at least the first step towards a trade deal, we can see that Fortinet pre-market is up 3.4%, along with the rest of the market. So it looks like it's going to get back to over $100 today. We shall see. And at that point, Fortinet will almost have recovered to where it was prior to the earnings at around $106. I already mentioned the highlights of the income statement, but I just want to show you in raw numbers how staggering their growth really is. You can see the total revenue at $1.54 billion, up from $1.35 a year ago. And they're also doing a great job of increasing their gross profit, increasing those gross margins, more importantly. That signals the demand is still very strong, as well as gaining market share. Every single quarter, this business just seems to post remarkable numbers. The real highlight of the earnings report is the cash flow. This is the cash flow from operations, $863.3 million. Pretty in line with last year at $830.4 million. But look at this. Their CapEx spend was only $66.5 million, compared to that last year of $221.9 million. On the earnings call, they said that is due to the reduction in land investment, but what that means for us as investors is that it's a massive influx of cash into our pocket. That's free cash flow of $797 million in this quarter compared to $609 million a year ago. In fact, that's a free cash flow margin of 51.75% compared to 44.96% last year. They're expanding margins on all fronts. This is the guidance that they came out with, and for some reason the market just thought this was terrible and punished them. 8% the day after the earnings report. For Q2, they expect revenue in the range of $1.59 to $1.65 billion. Again, that's where you get that midpoint of 1.62. But for full year guidance, revenue, service revenue, and billings all remained the same. Actually, so did the gross margin. But what they did do is expand the range of their operating margin, 31.5% to 33.5%. Compare that with 31% to 33% for the full year guidance at the end of last earnings report. They actually raised their guidance for the operating margin, and the market still punished them in the way they did. This demonstrates the growth of Fortinet over the last 10 years or so. Just a steady, reliable increase in revenue, gross profit, operating income. See, over the 10 years, they've grown their revenue 22.7% annually. They've grown their earnings by 54% annually. And of course, on the free cash flow basis, they've grown that by 27.6% annually. And you can see the returns have reflected this amazing growth. 28.8% annual return over the last 10 years. In the last 1 year, a 67.5% return. Their cash balance has steadily increased, and they're compounding their free cash flow. But to me, this really demonstrates how good of a growth business Fortinet really is. Incredible margin expansion for gross margin, operating margin, and free cash flow margin. Gross margin sitting at 81.3% on a trailing 12 basis, operating margin at 31.5%, and free cash flow margin at 33.7%. This really underscores the demand for their product. They're growing their market share as well as improving their operational efficiency. And you can see that also reflected in the ROIC, which now sits at 30% and an ROCE of 40.3%. This margin expansion and very high ROIC should set up amazing returns for investors in the years to come. And on that note, what does their DCF going forward look like? What can we expect to be a good buy price for this business? Their historical product segment growth is at 19.3% on a 5-year basis and 24% for the services on a 5-year basis. My bear case and bull case, however, total revenue at least, I have 7.8% for the bear case growth over the next 10 years, 9.9% for the base case, and 12% for the bull case. I'm being quite conservative on my revenue growth over the next 10 years compared to what they've done historically. And the bull case is about in line with their 3 to 5 year projected growth based on analyst projections. Margin expansion on the bear case, expect that margin to be at 32% by year 10, 37% on the base case, and 42% on the bull case. This is largely driven by the growth in services, which is a much higher margin business than the product segment. Services makes up for almost 70% of Fortinet's total revenue. And finally, by year 10, the free cash flow margin I expect to be about 35% on the bear case with 9% free cash flow growth over the next 10 years per year, 42% margin on the base case with 13.1% growth, and nearly a 50% free cash flow margin by year 10 on the bull case with 17.25% annual growth. So like I said, Fortinet went into the weekend with a $97.42 share price, trailing 12 earnings per share of $2.43. It gives us a PE ratio of 40.1, which is far below their 5 and 10 year average, and have a forward PE of 44.9, slightly above their 5-year average, but well below their 10-year average. We should expect to see a share price pop today, however, and on a DCF basis, I have a bear price at $85.38, base case at $115.74, and a bull case price of $158.31. My exit multiple sits at $106.64. I'm using comps of Palo Alto Networks, CrowdStrike, VMware, Qualys, Juniper Networks, and F5. So you can see there's still quite a bit of upside on the base and the bull valuation cases. And ultimately that would give us a buy price of $114.54 with no margin of safety. But with a 20% margin of safety, we're at $91.63 and a forward PE of 42.4. Now I believe Fortinet is a very safe and reliable business. They've proven that now time and time again. And cybersecurity as an industry is going to grow like crazy over the next few years. So even if Fortinet doesn't grab more market share, which I expect they will, the overall pie is simply going to get bigger for the cybersecurity industry. So you could put a 10% margin of safety on this business, which gives us a buy price of $103.08. Depending on what they do in the market today, it might still be under that. We shall see. But right now, I'm more comfortable waiting until Fortinet comes down into the low 90s before buying more. The last time I bought Fortinet, when it was around $87. I would love to see it come down below that again, but it looks like that's not going to happen anytime soon. So depending on your margin of safety, this could be a very good buy right now, or you might want to wait a little bit. Either way, this is an excellent business, and I think it's going to grow very well over the next 10 years and make all of its investors very happy. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.